Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, the weekly insights into the topics that we've been discussing here at Quilter Cheviot. So as to not miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. My name is James Coker, and I'm an investment manager based in our London office. I'm delighted to be joined by our regular commentator and head of fixed income, Richard Carter, as well as Mamta, Valechha, our consumer discretionaries analyst. Good morning to you both. Last week, markets rose as prospects for a resolution between Iran and the US became more likely. Indeed, on Friday, Iran's foreign minister announced that the Straits of Hormuz would be open for the remaining period of the ceasefire. However, the détente reversed over what was a chaotic weekend. The US Navy seized an Iranian ship on Saturday, and Tehran retaliated by firing at vessels and reimposing controls in the Straits. Oil futures have risen in response, but remain just shy of the $100 per barrel level that shot through at this conflict start. Last Thursday, we learned that the UK economy grew by an estimate beating 0.5% in February. The strength came from a combination of production and services, but the year-on-year construction level let the side down. Now, this, of course, is historic data and does not capture the fallout of the Middle Eastern conflict. So, turning to Richard, does this unexpected strength going into the conflict reassure you, or will the fallout from the conflict more than undermine the good news from this report?
Yeah, I mean, I think, James, it was good news, and the government, frankly, at the moment needs all the good news they can get. But I would always take month-on-month GDP numbers with a massive dose of salt. I mean, often there's things in there that get revised away. There's also weather-related and sort of data timing kind of issues as well. And that was the case in this report. Although, yeah, it was, obviously 0.5% a month is a very strong number, and it wasn't all distorted. So that's encouraging. Looking ahead, yeah, I mean, the sort of whole Middle East shenanigans and the back and forth on peace talks and all the rest of it definitely is going to be bad news. We know we're going to see a jump in inflation in March. It's going to undermine consumer confidence and hit things like retail sales. So it's not, clearly things are going to weaken, but it's nice that the economy was in an okay place going into the conflict. And actually, in some ways, and it's not just about the UK, we haven't really seen yet a massive hit to the data from the whole Iran thing. It's still early, and we may see that, but so far, not just in the UK, the sort of data is holding up reasonably well. But clearly, the longer it goes on, the more we're going to see growth estimates revised down.
And just speaking to those anxieties around the jump in inflation, this concern is playing out in the sovereign debt markets. Last week, we saw the UK government sold a 10-year bond at its highest yield since the global financial crisis, at a starting yield of 4.92%. Despite this being the highest initial yield paid in 16 years, the offer was 10 times oversubscribed, which implies strong demand. Indeed, we've seen quite strong demand across other corporate issues as well. Does this suggest to you, Richard, that investors are seeing value in fixed income, or does this perhaps indicate that yields are topping out?
Yeah, I mean, I think I'd probably pay more attention to the high yield being, the gilt was issued at necessarily more than the demand. I mean, demand was very strong, but often with these syndications, they do tend to be oversubscribed because, people buying the bonds know they're going to be scaled back. But yeah, I mean, I guess it was a sign of robust demand. And like you say, you have seen that in sort of corporate bond markets as well. I mean, I think the move in yields we've had reflects the increased inflation concerns. But if you look at where starting yields are now, you're up between sort of 4.5% to 5% on UK gilts. You're able to get around about 5.5% or more from investment grade corporates. And even if you look at sort of pretty bearish estimates for where inflation is going to head this year, that yield is still comfortably above that inflation rate. I mean, the worst sort of forecasts I've seen so far are around about 3.5% to 4% on UK CPI if the war carries on for a while. So your starting level of yield is pretty good. Interest rates, central bank interest rates are they could go up, but they're relatively high at the moment. So I think demand for fixed income is pretty strong. Whether we've seen the peak in yields depends a lot on what Trump and the Iranians agree, and also worth mentioning again, of course, we've got the whole Keir Starmer issue about his position, and that if he were to go and to be replaced by a more left wing PM, then that might push gilt yields up a bit further as well. So yeah, we may not have seen a peak in yields, but certainly, like you say, demand is pretty good.
Thank you for that. So, as you were saying, it's more of an all-in yield preference than necessarily a play on spreads or duration per se. You raise an interesting point about this crucial juncture we're moving into with scrutiny around Sir Keir Starmer's position as PM. Of course, just coming into the May local elections. I appreciate we're not political analysts. Our focus is more on markets and economies. But do we know who is likely to replace Sir Keir Starmer if indeed his position does become untenable? Of course, Angela Rayner came under scrutiny herself last year. So would someone like Deputy PM Lammy be considered for the role? And if so, could you just perhaps give us a word or two on what the market implication would be?
Well, I think the markets would like Wes Streeting the most because he's seen as sort of being to the right of the Labour Party, and then Angela Rayner would not. I mean, I don't think it's going to be sort of carnage in the gilt markets if Angela Rayner becomes Prime Minister. I mean, whoever is in charge is going to be faced with a similar kind of financial problems that Starmer is and the Tories were as well. The fact that borrowing's too high and debt levels are too high, and they need to get it under control, because if you lose the respect of the market, you've got a big problem. I mean, I've seen a few names banded about. I mean, Andy Burnham was obviously one, but Starmer managed to kibosh his chances of becoming an MP at that by-election recently. I think Lammy's a possibility. Ed Miliband also I saw mentioned over the weekend as he's done the Labour leader before. But there's no one immediate and obvious. And it's not clear, unlike when you have this sort of issue with the Tories, how the process would work to get a sort of new leader in place. I think it might take resignations from the cabinet before this moves to a stage where Starmer has to step down. So we'll see if that happens.
Marvellous. Thank you very much, Richard. From potential hung parliaments to handbags. Mamta, last week we gained an insight into the performance of the luxury industry's grandees, including reports from LVMH, Kering, Hermes. Mamta, what themes emerged from these earnings reports?
Yeah, so firstly, and quite unsurprisingly, the adverse impact from the Middle East conflict was a key focus. So the Middle East makes up about 4 to 6% of group revenue for these luxury companies, and it is quite a profitable region for them, given higher price points and greater tourism, particularly in the UAE. But we not only saw demand being hit in countries within the Middle East, but also in Europe and Japan, where around 50% of demand is tourism led. So, whilst the direct impact may seem minimal at first, the second order impact from tourism is not insignificant. The other thing that stood out was whilst other regions showed mixed performances, the US remained resilient across the key luxury houses. And finally, jewelry continued to show good momentum versus soft luxury, which could be a good read across for Richemont, who doesn't report until the end of May.
Thank you. And which categories, and if it's not too reductive, stocks remain your top picks given this environment?
Yeah, so as I touched on, branded jewelry continues to outshine soft luxury pieces such as handbags. Currently, branded jewelry offers better value for money in the eyes of the consumer, and it is a segment which offers a wider breadth of price points, so basically making it a bit more accessible. Richemont is the leading player in the market with iconic brands such as Cartier, Van Cleef under its portfolio. So I would say, Richemont sits in the quality and momentum bracket at present. And then you have the self-help and quality bucket where LVMH sits. The disruption in the Middle East overshadowed the ongoing improvement in the underlying business where it would have mattered. So, firstly, at Dior, where new creativity under Jonathan Aniston is helping the brand propel sales, and this complements the strong Louis Vuitton business. And secondly, local spending by Chinese is now positive. In fact, management called out Asia seeing the strongest quarter since 2023.
Thank you. Yes, and just with regards to LVMH, it's a bit of a bellwether for the industry, given its sort of breadth of different categories. Um, does that represent a bit of a safe harbor of diversification in what's been a slightly tricky period for the luxury names? Because would you rather be allocated in a company that just focused on, say, the jewelry category you mentioned that Richemont specializes in?
Yeah, so that's a great question. And for those who are listening and don't know, LVMH houses around 75 distinct brands across 6 different sectors, including fashion leather goods, wines and spirits, watches and jewelry, and also retailing. In general, this diversification strategy does help LVMH to mitigate risk and capitalize on opportunities in different segments of the luxury market. And even within a sector, it allows them to cater for different clientele's preferences and price points. But of course, under severe downturns, this can lead to simultaneous softness. And if you take the wines and spirits division at present, which has been struggling for a while, given the weakness in China and also the US, one might question, does the group even need exposure to this industry? But despite this, despite the weak performance, LVMH remains committed to keeping the division within its portfolio because for them it's not just about profitability, but it provides a link to its heritage and prestige branding via brands such as Moet and Hennessy. But ultimately, the key sentiment driver of the stock remains the fashion and leather goods division. It makes up about 75% of group earnings, and it is almost irrelevant to the share price, what the other smaller divisions do.
Thank you. And just a quick word on another high prestige company focused on that fashion and leather goods business. Hermes had a reported, I believe, last Thursday, and well, the market took a dim view of that performance. Um, was that mostly valuation driven? It is one of the more expensive luxury goods names. Or was the sell-off driven by something perhaps more sinister?
Yeah, so when you're trading on multiples of over 40 times price to earnings or even 30 times, you are basically priced for perfection. For Hermes, it is the power of its brand and scarcity-driven model which has afforded it with its multiple. But as you mentioned, results last week really left the company exposed. Now, Hermes has suggested in the past that its sales are driven mostly by local clienteles, but in fact, we found out that on average, 50% of its sales in Europe for Hermes are in fact by tourists. Some investors also remain concerned around the growing size of the leather goods division and its potential implications for brand exclusivity and long-term growth. And finally, there's also, said to be an increasing supply of bags on the secondhand market, particularly in China. Now, speaking of China, China also showed a sequential slowdown, which was not yet seen at other peers. So while many investors, now would be keen to buy Hermes on the cheap, and I say cheap with quotation marks, a weak start to 2026, only reinforces preferences for self-help stories. So, brands re-injecting creativity into their portfolio and for exposure towards categories with strong momentum, such as jewelry.
Yeah, delighted cheap was offered in quotation marks. I know the wife would certainly love a Birkin if it became available. Um, a problem child of the industry of late has been Gucci, which accounts for a very large proportion of Kering's sales. Again, we saw sort of continued pressure in their earnings last week. What accounts for this pressure, and what would lead you to change your mind on the stock?
Yeah, so quarter after quarter, we have seen that it is easier and faster for the market to believe in a revival than it is for management to actually produce it. Now, CEO Luca De Meo officially joined on September 15th of last year. He's very regarded very well for his track record at Renault, but he's not a luxury specialist. And then you also had Demna taking over creative direction at Gucci, which has been so far, kind of encouraging. So far, as I mentioned, Kering has been able to excite investors with creative debuts, store rationalization, balance sheet fixes, and M&A. However, and we may be oversimplifying matters, but with 60% of group's EBIT accounted for by Gucci, the turnaround of the Gucci brand remains key. Now, results last week showed that perhaps Gucci by Demna seems to have caught on with the Americans, but interest across all other nationalities has yet to be proven. Sales at Gucci remain down 8%, and the all-important Chinese consumer likely remains down mid-teens. So turning around Gucci and to a lesser extent the smaller brands, Saint Laurent and Balenciaga, will require further major improvements in several luxury specific fields, such as getting the product right, communication, and also distribution. And we are basically in a wait and see mode regarding these elements. We also believe, guidance for financial year 26 remains quite ambitious, as is the 2030 targets to double EBIT by then. We think that's quite aggressive as well. So at present, in our view, execution risk remains quite high, and we prefer to wait for clearer signs of a top-line inflection at Gucci to get more excited on the name.
Thank you very much, Mamta. Those are great insights. So looking ahead to the week in front of us, investors await sentiment indicators from major economies such as the US, UK, and Germany. Investors will pass these PMIs for clues about how companies are navigating the conflict in the Middle East. We also have US retail sales tomorrow, followed by the UK labour market data, and then UK's March inflation data on Wednesday. Our analysts will be busy with a flurry of corporate reports published this week as the new reporting season is in full swing. Some highlights include Tesla, SK Hynix, Procter & Gamble, General Electric, American Express, and Blackstone. It'll be interesting to see how some of these companies offer a adjusted EBITDA, which has sort of been taken to mean earnings before Iran tariffs and dubious announcements, he says facetiously. And that seems like a really good place to end it. So thank you very much, Richard and Mamta, for those wonderful insights, as well as to you all for listening. Did you enjoy our discussion on the podcast today? If so, we'd love to hear from you. So please do review the show and share it on your socials, tagging us at Quilter Cheviot. So as to not miss a future episode, please tap the subscribe button. We'll be back next week, but in the meantime, please do head over to our website at www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date on our thoughts on market news, industry insights, and our upcoming events and webinars on our website or via our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? If so, simply submit them via the weekly comments page on our website. We'd love to hear from you. And that's it for today. Again, a big thank you to Richard and Mamta for your time, and to you all for listening. Until next time, goodbye.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.